Hello and welcome to the Don Harkins Real Estate Show. Today we're going to be talking about real estate news, mortgage news, and some changes for property managers and landlords. Whether you're a home buyer, a home owner, a real estate agent, or a mortgage professional, we're going to cover topics in here that you're going to find valuable in any of those roles. Specifically, what we're trying to combat today is all the misinformation about housing. And I'm going to give you 5 bulletproof, reliable sources of information that you can rely on. You can bookmark these sources, and week after week, month after month, you can get an accurate temperature of the real estate market without falling victim to the various headlines that you're seeing that are seeking to mislead consumers in order to sell financial reports or in order to motivate you to take an action, whether it's buying or selling at a time that might not make sense to you, or just with a perception of the market that might not be true. So I'm going to give you some bulletproof, reliable sources that are going to be correct and true so you can form your own opinions about the market and rely fully on the information that you're taking in. And what we're seeing more and more of right now is contradictions, just like this article right here. America's housing market reaches inflection point. And what they're talking about is newly built homes are cheaper than existing ones. And this has only happened a couple times in history, and it's not a good sign for the health of the market. But at the same time, another article comes out and it says the fever gripping the housing market seems to be breaking. Here's why. And it talks about lower mortgage rates and better inventory. And so who are you supposed to believe? Are things getting better or are things getting worse? And we're going to clear that up for you. You're not going to have to worry about it anymore. You can just bookmark these sites and you can rely on this information yourself. And you don't have to stand for an interpretation by someone that just realistically has an ulterior motive. So the first source of information that you should bookmark is FHFA. This is the organization that's in charge of Fannie Mae and Freddie Mac, the secondary mortgage market participants. And FHFA publishes a great report, and you can rely on FHFA for the house price index or home price index. And what you see here are the top 100 metro area rankings. And this is just going to give you a real good temperature about what's happening in the market. You can see here there's a quarter over quarter change and there's a year over year change. And so it starts the top of the list. If you hover over any market here, it's going to give you a high level look and say Newark, New Jersey, 11.6% year over year change over the last year. And then you see at the banner here over on the right hand side, it says the United States house prices rose 4% over the past year. You can see quarter over quarter some sustained growth, but pace of growth, while it's been roaring in Newark, not quite as fast over the last quarter as what it's been here in Providence or even Detroit. So you have some of these markets that are seeing incredible price growth year over year, double-digit price growth. And this is sort of a reversal of the COVID moving trends, because if you look down here at some of the underperforming metros, what you're going to see is a lot of these are sitting in the areas that overperformed during COVID. So you look at Tampa. Tampa's showing a 0.6% decrease year over year, a third of that just in the last quarter. St. Petersburg, same thing, some of this related to the hurricanes. You look at the worst performing metro on the list, and that's Lakeland Winter Haven with a 9% year over year decrease in value, 4%, almost half of that just over the last quarter. Fort Lauderdale also underperforming, losing 4.8% over the last quarter alone. So this is really a reversal, people kind of moving back home. We knew that remote work was ending. And so as we see people return to those areas that they originally moved from and start to settle back in and get back to jobs or back in the office, we're seeing some of that rapid population and price growth unwinding some. But nonetheless, this is the place to go if you want to know what's the value of my home, what has it done over the last 3 to 4 months, what's it done over the last year. Be sure to bookmark the FHFA House Price Index, and you can look at this. They update this monthly, so you can come back to this over and over and over again to get a look at exactly what's happening with home prices. Home prices are obviously affected by inventory. And so this is the next place that you should bookmark. This is the National Association of Realtors. So unlike Zillow indexes, Redfin indexes, published news sites that sell ads that have something to gain by your traffic and scaring you, the National Association of Realtors employs economists, and they are paid solely to report the data for the benefit of realtors. There's no incentive to craft a story. These economists are not paid if the market's good, or worse if the market's bad. It's just strictly a reporting of what the data is. And so the report that you should be taking a look at and relying on from the National Association of Realtors is the existing home sales report. So existing home sales is going to tell you, are people moving more or moving less? This takes new construction out of the picture because new construction is so volatile, and quite frankly, home builders like to play with their numbers and sell property without listing, or over-report their number of sales and put buyers under contract and cancel them to fudge numbers. So this is the most accurate picture, existing home sales, of what the pace of the market is. So you can see here, if you look back in 2021, in July, we had really high. We peaked at 6.4 million existing home sales. And then we slid to 4.8 million, slid to 4.4, 4.3. And then last year, there was a headline in November. Basically, in 2024, this was the lowest number of existing home sales that we've seen going all the way back to 1992. So very low pace of existing home sales. And the other thing that's interesting here is it's been pretty low for a long time. So going all the way back to September of 2023, we've just seen below average existing home sales. So while you can see the market really hasn't picked up steam, it's not really taking off, buyers and sellers aren't really jumping back in, we've probably hit a floor here, and we're probably looking at a lot of pent-up demand, a lot of people who've been sitting on the sideline since 2023 in July, who are going to be coming into the market as soon as we see rates drop. But this is another good report that you want to save. And the nice thing about this, they actually publish the individual market data as well. So if you want to break this down regionally and see just exactly where you're at, you can see percent change in sales from 1 year ago based on price segment and based on location. So you can see the 500 to 750 price range in the South has outperformed by 3.5%, versus if you look at the US as a whole, the 250 to $500,000 price range, underperforming that a little bit. In the West, 500 to 750, a little bit slow. Best price segment for growth in the West is really the entry level 100 to 250, but that's underperforming in the Northeast. So really nice to be able to look at the line by line, low level data that goes into the higher level reporting and graphing that they do. But that's the second source that you want to save, is National Association of Realtors existing home sales. The third one you want to say is Cotality, their home price trends. So this used to be CoreLogic's home price index. CoreLogic home price index has been relied on by Wall Street traders and hedge funds and bond traders for a long time. They are a third-party company that compiles and scrapes MLS data to try and give information for stock traders to be able to use, and Wall Street to be able to use to price their positions. So you can bookmark this Cotality home price index. This is just a fantastic report. It comes out once a month. This is the August data that we're looking at. What we see into the spring 2025 market ended softly with slower price growth. We've got year over year price growth dipping to 1.7% in June 2025. And they go on to give some more context. They show you some month over month and year over year national home price growth. So the current is 1.7%. The forecast was 4.2%. So a little bit of an underperform there. An affordability meter talks about how fast it's growing. Again, gives a context to what the forecast was. And then if you go down a little bit further, they break out this data a little bit more and they show you the hottest markets. And what we're seeing again, that Northeast overperforming some. And then the coolest markets, we've got some in Texas, some in Florida. Again, these were the states where people were moving to during COVID. And if we look at the most underperforming markets in Florida, you've got Homosassa Springs at a 1.5% year over year decrease, Cape Coral at 2.9%, Naples at a minus 3.3%. So you can get a good insight into home prices here, which areas are affordable. They've got most affordable being in Pennsylvania, West Virginia, and then least affordable coming in predictably all five in California. No surprise there. Markets to watch. So high risk market home price trends. So these are areas where they think home prices may be poised to fall. And you can see here we've got Lakeland, Cape Coral, Northport, St. Petersburg, West Palm Beach. And ironically, so, it's a good thing when you're going to first source data like this and you're seeing correlation. CoreLogic or Cotality is not pulling in from National Association of Realtors. National Association of Realtors is not pulling in from FHFA. They're all doing their own data collection and data analysis and reporting. So when you see correlation like this, where you see St. Petersburg and Lakeland as price markets where the prices are coming down and where there's a home price risk across multiple sites, these are areas where there might be good opportunity. If you're looking for a distressed seller, if you're looking to get a really good deal on a house, Lakeland and St. Petersburg are probably two of the top places you want to be looking, prospecting and marketing, trying to find a great deal on a home, because they're depreciating markets, and depreciating markets are going to have higher inventory where homes are sitting, and the most motivated sellers are willing to give the best deals. We've got our three sources so far: FHFA, we've got National Association of Realtors, and we have Cotality, formerly CoreLogic. This next source is going to be where you should go for mortgage rates. My goodness, the amount of misreporting from real estate agents, quite frankly, as well as news sources, and even worse, sites like bankrate.com that are basically lead generators for mortgage brokers. It's so hard to get an accurate picture at what the mortgage rate really is in the real world in real time. And this is the place to go. Freddie Mac, the absolute authority. They are the ones purchasing these mortgages. Nobody knows better than them. They run a weekly average. You can see how real time this data is. This is a weekly average as of today, 6.58%. They show you the 1 week change, the year over year change, 0.12% higher than we were a year ago. The monthly average, so are we below or where we were for the previous month? And the 52-week running average. So, they give you a graphical representation of where you're sitting within the 52-week range. Super, super reliable and super helpful. Any real estate agent, even really any mortgage broker, certainly a consumer that has any interest at all in tracking the real estate market, you can't talk about what the market's doing and understand where the market's going without understanding where the interest rate is. They're absolutely married and correlated. So that's going to be the first information source you want to save. The last one, Mortgage Bankers Association, and this is the Mortgage Credit Availability Index. You're going to look at this to start to forecast and understand a little bit. Are buyers having a tougher time or having a harder time getting mortgages? Are loans going to be more available or less available? And what you'll see here, they give a little bit of context. They say the MCAI, this is the index of the Mortgage Credit Availability Index. MCAI rose by 0.2% to 103.9 in July. A decline in the MCAI indicates that standards are tightening, while increases in the index are indications of loosening credit or additionally available credit. So as you're watching the MCAI over time from the Mortgage Bankers Association, you're starting to get a sense, okay, what can we say about the market right now? We can say, well, the pace of sales has been slow. Mortgage rates are steady. Some markets are appreciating a lot. Other markets geographically are starting to decline some. what's the availability of financing for buyers out there who are able to purchase or who want to purchase if they want to jump back in the market. And what we're seeing over time is that credit availability is slowly starting to increase. So we saw, obviously, as we came out of, I'm guessing this is going to be the Great Recession right here. This is actually a COVID graph. So as we come out of COVID, the amount of mortgage credit available here, the reason you're seeing this being so high is that the Federal Reserve was in there buying mortgage-backed securities, driving down the cost of mortgages. And as you drive down the cost of mortgages, more people can afford them. You can originate them cheaper with less risk. So that's why you see it spike. As you saw the interest rate, this is not just a inflation report that's driving this down. This is actually the Fed stopping their purchase of mortgage-backed securities and letting mortgage-backed security bonds return to actual market-based pricing and have to be absorbed by the free market. And so as demand for those cools off, the price that they have to be originated at, or new mortgages have to be originated at, has to rise. And so as that rate rises, the number of people that can afford mortgages starts to decline. So you can see we hit a little bit of a bottom here, and this is in March of 2024. And since then, we've been seeing pretty steady increases in mortgage credit availability. So this is just another great source. They break it down, governmental. This is your FHA and VA stuff. This is your conventional stuff, and minor differences there. But the jumbo mortgage credit availability, you can see increasing a little bit more than others. But just another good, unbiased, absolutely accurate source of information that you can save to monitor the market, draw your own conclusions. Those are your top 5 sources of information. A couple other bonus sources. So Freddie Mac, we're going there for the interest rate. Fannie Mae, the other government-sponsored enterprise that operates in the secondary mortgage market, they've got a home price expectation survey. So this is predictive, looking at where prices might be going in the future. And it's, it's a survey. They survey, I think, like 100 people. You can actually download the survey and see all the participants, latest panelist level expectations data. This is probably where we'll see those person by person pieces of data. Let me see if I can bring this onto the screen for you guys to see. Doesn't look like I'm going to be able to, unfortunately. What we'll do is we'll actually screenshot this and bring it in. Okay, and I'm going to jump ahead real quick. All right, so as we drop this in, what you're seeing here is all the individuals that respond and report in and what their responses and reports were in this actual survey. And it's a pretty wide variety of people. So you've got chief U.S. economists, chief legal officers, principals at mortgage firms, all kind, presidents of banks, all kinds of different people who are weighing in. You can see their affiliation, where they work, and then you can see the date they responded. And then this survey, what it's doing is it's asking them to say, what do you expect that rates are going to be at the end of this year, the following year, and the next 3 years after that. So you can see on this particular survey, you have reports all the way out to 2029. And then one thing that Fannie Mae does pretty nicely is they graph that out and they show you, okay, this is sort of the most pessimistic responses, the most optimistic responses, and they kind of break it down where you can see what the spread is. So that's what you're looking at here is the results of these panels. So you've got 2025 expecting a total price growth of 2.9%, 2026 annual price growth of 2.8, 2027 annual price growth of 3.4. We just saw that we're about 1.9%. So the assumption is going to be that over the next 4 to 5 months, we're going to see another 1% growth in price if that survey stays accurate. They also, instead of just having the home price expectation survey, they have the home price index. So, I personally prefer some of the other home price indexes and CoreLogic's number, but Fannie Mae has a home price index as well if you want to just track values. Again, another unbiased source. Rounding this out, consumer price index. So if you go to the St. Louis Fed's website, they're going to show you the consumer price index month over month. This is going to tell you where interest rates are heading. So we're sitting right now at the lowest levels of rates that we've seen in a long time. And now rates are starting to bounce a little bit as inflation bounces. So CPI, good to track. It's really interesting. You can track commodity level pricing here. So we saw that big spike in lumber during COVID, and now we can see, all right, well, I wonder, is it getting cheaper or more expensive to build a house? Well, tracking some of these commodities like aluminum and lumber are going to tell you, is home price building coming down or is it starting to increase? And so you can see here, pretty slow increase and then some leveling off over the past essentially 7-8 months of commodity prices. Other things you can track here, consumer credit card balances. So, as a mortgage lender, you're thinking, okay, well, we're going to see an increase in refinances because we know we have a ton of home equity, but we're looking at historically high balances on credit cards. As someone who's trying to figure out what is the pace and ferocity of the housing market going to be moving forward, ideally you would like to see this number coming down. And if it continues to rise, you start to wonder, are people going to be able to afford new homes? Or are they going to be able to qualify for new homes if they're carrying this much consumer credit card debt? One of the reasons we saw prices rise so much and we saw that mortgage credit availability so high is, yes, rates were being driven down by the Fed, but also people were getting stimulus money and big paychecks, and they were actually using it to pay off consumer debt and credit card debt, which allowed them to qualify for bigger mortgages and pay more for houses. So it's another great item to track if you're trying to watch and understand the housing market. 30-year fixed rate mortgages over time. So if we're looking at a real-time snapshot or a really close window, stick with that Freddie Mac source. But if you want to look over time and get a little bit bigger perspective at where rates are, this is going all the way back to the 1970s. And I always tell people, they say, all the time we're asked by sellers and buyers, are rates going to come down over the next 6 months, over the next 12 months? Should I wait? And this is just the best example here where rates are down. Rates are down quite a bit. And if you look at for how much, since we've been tracking this, how much time rates were higher than where they are today, we can go back to basically 2001 all the way back to 1971 for 30 years. For a 30-year period from 1971 to 2001, you could not get a mortgage as low as you can get one today. So when rates started to rise there in, basically 1977, and they took off, they're sitting around 8%. When did they finally come back below 8% from 1977? 1991. 14 years, mortgage rates stayed high for 14 years. Incredible. So are rates going to come down? Rates are down. They're already down. So if you need to buy a house, go buy a house. Rates can go higher than this, and they can stay that high for 15 years. We've seen it in, just the last 50 years. Another good site, the United States Census Bureau. If you want to see where people are moving from and coming from, they've got great migration data in here. You have to download the Excel files. It's a little bit more challenging to glean insights from, but nonetheless, it's fully reliable. Back to FHFA, they've got a blog there. And then this consumer price index summary from Bureau of Labor Statistics. So CPI is the biggest driver of the Fed funds rate, and what Chairman Powell is doing. That's the biggest thing that they're watching is inflation. And this is the biggest mover of rates in between Fed meetings. So when you look at the actual CPI number, you can get this, bookmark the Bureau of Labor Statistics, go in and download the CPI summary. You can see line item inflation, and you can see, well, what's contributing to the most inflation? Where are prices going higher and where are they coming down? And so you can look at stuff like food, and you can see, year over year of the last 12 months, food prices are up 2.9 on the index. Restaurant prices are up quite a bit. Energy prices are down. Energy commodities are down. Gasoline's down. But what I was going to get at here is shelter. These are not all equal parts of CPI, and shelter is a big part of CPI. And so we can see shelter's been lower. We had a couple readings of 0.4, but now we're 0.3, 0.2, 0.3, and then 0.2 over the last couple months. Annually, 3.7. We're probably going to lose this 0.4 and have that drop off as we were seeing home prices continue to stabilize and interest rates coming down a little bit lower. We're going to talk in a second about rents and what rents have been doing. They're coming down. So this is good to watch. Look at what the weighting is, the different categories. But if you're trying to figure out what's happening with real estate, pay attention to what's happening with inflation, because as inflation comes down, interest rates come down. As interest rates come down, home prices go up. As interest rates come down, more buyers hop into the market. There's more home sales occurring. So that will help you get some good insights into what's happening there. Hopping a little bit over to what's happening with mortgages specifically and just getting a little bit of an update. So Fannie Mae forecasts don't expect mortgage rates to fall much more over 2025. And basically what this is saying is Fannie Mae gives an annual prediction of where they think rates will be. And they were saying they thought rates would be 6.4 by the end of the year. They've revised that up. They now think rates will be at 6.5 at the end of the year. And so they're saying that's a downbeat outlook. And they also revised their total home sales expectations to 4.74 million from 4.85. So Fannie Mae coming out just recently and saying, look, we think there's going to be a lower number of home sales occurring over the rest of the year. And we think rates are going to be a little bit higher than we previously anticipated. And then the last thing I want to look at is the recent passing of this bill in the Florida legislature. This just passed in July, went into law. And you can see here, it's an act relating to electronic delivery of notices between landlords and tenants. So creating a Florida statute, chapter 83-505. So this is the Florida Landlord Tenant Act. And what it's saying is it's authorizing a landlord or a tenant to electronically deliver notices to the other party if certain conditions are met. It requires an addendum to the rental agreement. That addendum has to be in a very specific form. It authorizes one of those parties to revoke their agreement. Specifies as when the revocation takes effect, authorizes a party to update his or her email address, on and on. So it goes into some details here, but basically what this is getting at is it's making it a lot easier for landlords to manage tenant communications and a lot more effectively notice tenants who aren't paying or get tenants out at the end of a term of a lease. No more of this saying, well, I didn't get the notice. Well, I posted the notice. Well, I didn't see it on my door. This is going to eliminate a lot of that. So if you own rental properties in the state of Florida, be sure that your property manager or yourself are adding this addendum into your leases so that you can have absolute tracking and records of what your notices to your tenants are. You can operate a lot more efficiently and a lot more effectively and a lot faster as a landlord managing your tenants moving forward. That's all I've got today. If you got any value out of this, please share this video with someone you might know who'd be interested in watching the real estate market and becoming better at predicting where things are going and less susceptible to being swayed emotionally by different headlines. Give us a like and a share and drop a comment. Let us know what you found most valuable. If you have any questions about the market specifically, I'm Don Harkins with Don Harkins Realty, the Don Harkins Mortgage Team, and Sea Dog Property Management. Thank you very much for watching and have a great day.